Welcome back. You're watching the 80 Money Show with me, Kavita Thapliyal, and there are plethora of funds available in the market to invest your hard-earned money. But how do you assess which is the right fund for your portfolio? What are the criteria that one should look at? To help you navigate through this maze, we have on board Feroze Azeez, Deputy CEO, Anurati Private Wealth Management. Also, do not forget to send us your portfolio queries on our WhatsApp number, which is 865-797-4571, or you can email us your queries on themoneyShow@etnow.tv. So that's the place where we are waiting for your queries. And good evening. Welcome to the show, Feroze. And it seems we have a lot of time in our hands today. So let's start with a very interesting topic, which I wanted to understand from you. 2023 also looks like a year of diversification where you can go slightly higher in your debt when your portfolio is concerned. What can be the best pick in debt, considering the kind of financial goals people come up with on the show, keep asking, how should one diversify in debt based on a financial goal?
Yes, Kavita, see, like you rightly pointed out, that debt is an opportunity which is not worth missing, especially for Indians who have this inner desire to be in fixed deposits. Okay, which is supposed to be an asset class which got twice more money than the entire mutual fund industry. That's one of the estimates. So point I'm trying to make is debt is an important asset class. Second, debt is an asset class will require a different strategy. Debt may not need diversification if you're going to give it to central government. See, if you're going to lend it to government of India, then I'm not worried about diversification, because the basket, you don't keep all eggs in one basket. But if the basket is so strong that you're lending to the strongest person ever known for an Indian rupee bond, then you don't have to worry too much. So that's diversification not needed if you're lending to government of India. That's point two. Point three, in debt, the return itself is low. See, in equity, there's a potential of making 12-15%. Their cost is not so important as much as the cost being important in debt, because you're going to earn 7. You can't pay 2% cost when you're earning only 7. So low cost, concentrated sovereign credit and indexation and tax benefit can make people 6.5% post-tax if they're ready to hold a target maturity fund for 3 years. A target maturity fund which has a end date and a beginning date. Beginning date, not so much, but an end date of the bond is already fixed. That's called a target maturity fund. Low cost, non-diversified, sovereign credit is a great strategy to make 6.5% post-tax. 6.5% post-tax, Kavita, if you look at it, it is as good as a 10% fixed deposit. For somebody who's got a 30% tax, it's as good as getting a 10% fixed deposit. Tomorrow, if there's a newspaper ad which says 10% fixed deposit, everybody will run to that bank. But Government of India, in effect, is giving you a 10% fixed deposit. So why not choose it?
Talking about fixed deposit, that's a very interesting point that you mentioned. You know why? Because we are getting a lot of questions from viewers where they want to understand if a fixed deposit with a bank or a corporate fixed deposit will be good for them. In this scenario, what are the key points one should consider before deciding what kind of fixed deposit you should be going for?
Kavita, I'm sorry, I might sound very myopic or very closed-minded. I would not touch for my money with a barge pole any corporate fixed deposit, because especially retail investors are not capable to understand the credit risk of a corporate, point one. Second, this is the lowest form of security in a corporate debt. Corporate fixed deposits are unsecured loans. Unsecured loans in the hierarchy, if something were to go wrong with that company, the hierarchy of liquidation, secured debt comes above unsecured debt. So you buying as a retail investor unsecured debt from a corporate which you don't know how to read his balance sheet or understand whether he'll be able to pay you money back is very important that you don't touch. You may lose out on 0.5% return. You may lose out on 1% return, but it's well worth losing that return than playing around with hard-earned monies which you have accumulated over decades of hard work.
So, this is about FD that you've given your take, but then let's talk about different categories in debt, which we have. And the one that's very interesting to know that a lot of investors are interested in credit risk fund. Now, when we talk about debt giving you better return now, since there's been we are seeing interest rate hike, and this scenario is likely to continue for a few more times at least. Do you think this category of credit risk fund really makes sense, or you need to be of a different breed, know all the risk angle, and then put your money, park in your money in this?
No, Kavita, see, at least if there's a fund manager between the retail investor and your investment, if there's somebody who's a professional, I at least get some calmness. That somebody else is evaluating the credit risk. So, a credit risk fund will certainly score better than a corporate fixed deposit. Second, it will give you that tax benefit, unlike a corporate fixed deposit, which will give you interest income, this will give you capital gains and get you indexation. So that's the second advantage if I compare the two instruments which we have just been speaking about. The third is, as long as the credit risk fund has diversified very well, then you don't have to worry too much. So you can buy a credit risk fund. Fourth, your cost should not be too high. See, when Government of India can give you 7.3% on a 10-year investment, which is called the 10-year yield of Government of India, if that's 7.3, that's your birthright as an investor. Now, if the credit risk fund has a return of 10%, but if he's going to charge you 2% cost, then you're back to 8. So then it's not worth it. So a low-cost credit risk fund managed by a large AMC definitely can be of value to get you post-tax extra return, but without you having to worry about the credit risk evaluation.
These were some common questions, Feroze, which were asked by our viewers when it comes to debt investments. But then let's move on to our viewer queries today, which is the main highlight and the focus of the show with you. And interesting questions lined up. First is from Ramya, who says that Ramya wants to invest in mutual funds, and she wants to understand if it should be a lump sum investment or through an SIP. She has decided the time duration for herself. Now, for lump sum, she's talking about 5 years, and 10 to 12 for SIP. She wants to know the fund mix that you can recommend. But before that, I want to understand the time duration strategy that she's adopted. For lump sum, it's only 5 years, and then for SIP, she's talking about 10 to 12 years. So, can she do the lump sum in those same funds in which you would recommend her to do SIPs?
Yes, so there's quite a few questions intertwined into one, Kavita, like you rightly highlighted. First is the time frame. Is 5 years a good enough time frame to make a lump sum investment? Second, where to invest? Can the schemes intersect? That's the second part of the question. The first part of the question, which is 5 years good enough for equity investments? To my mind, in India today, where we stand, I think 5 years is a good enough time frame to make median plus returns. So 11-12% is what Nifty can give. And then if your good fund managers can give you that 2% fillip over your Nifty return, then you're getting to 12 to 14% or even 15% return on a 5-year basis compounded, which means in 5 years, money can double if it grew at 15%. That's the math of it. Secondly, why do I say so? Indian corporates have earned beautifully. It was 472 rupees Nifty earnings, then it went to 518, then it jumped to 777. That's all Nifty companies' earnings rupees per share of Nifty. Now we are looking at 840. Next year we're looking at 950. So over the last 3-4 years, Nifty earnings have doubled. So I personally think India is one of the best stories globally currently. And I think that should continue. That's from a 5-year standpoint. Good, Ramya. That's a good enough time frame for you to make good quality, tax efficient returns. Now coming to whether she can have the same schemes. Ideally, they should be the same schemes, because if it is good for monthly investments, it is logical that it should be good for lump sum investments as well, in my opinion. So same schemes. Equity investments on the SIP side, 10-12 years, I think should be the bare minimum, because salaries keep coming on a monthly basis. So till the time you earn or your goal comes, your SIP should continue. And the schemes which you can choose On the large cap category is Franklin India Blue Chip Fund. From the past performance standpoint, this kind of scheme might not figure in the best large cap scheme, but from a future standpoint, we think it is promising. DSP Equity Opportunities, SBI Contra, Kotak Emerging Equities, HDFC Flexi Cap, and ICICI Focused Equity. These are the 6 schemes, Ramya, you can use to build your lump sum portfolio and also do the SIPs there. For your lump sum, you can have maybe 20% of your money in the lump sum category in the debt side by using IDFC Gilt 2027 Index Fund.
Feroze, one question. SBI Contra Fund you've recommended, Ramya. So, why this recommendation and how will it help her portfolio to gain more returns?
Yes, so now that you've picked the most interesting fund out of the 6 funds, Contra Fund, SBI Contra, Dinesh is the fund manager. SBI Contra is a smaller scheme from a large fund house. SBI is the largest fund house in India currently as per the average assets they manage. SBI Contra is a small scheme. So the agility of this scheme is going to be so much more. The fund manager would be able to implement changes because the size is not too large. Second is, it takes a contrarian approach. A contrarian approach is digressing from a herd mentality. When you're not going to do what everybody else is doing, it could be a good complementary constituent to one's portfolio. Because if 5 funds are doing one thing and there's another fund which is by design contrarian, not doing the bhed chal or herd mentality, like we call in Hindi as well. So I think that's why it has a complementary nature to the next 5 of them. And since it's a smaller scheme with a larger fund house, that itself has a potential to generate return. Over the last 1 year, when we've been recommending it, it has beaten Nifty by about 9-10%, which is a handsome alpha over the last 1 year.
Interesting point you made that it is a small size fund. Do you really think that if the fund is of a large size, then it becomes difficult for the fund manager to make changes, and the kind of flexibility that's needed, to change the allocation of the fund somewhere down the line gets restricted if the fund is too large?
Yes, Kavita. I think how much ever quite a few fund managers deny that size has anything to do with performance, in our firm beliefs, and if you look at some variables which substantiated mathematically, larger the size, lowers the agility, lowers the potential of generating alpha. See, it's not going to be very easy for a 20,000 crore fund to sell his top holdings. Whatever, we might be operating in the large cap space, but it becomes very difficult to implement a transaction where you have to sell 1,000 crores of a specific stock and buy something else for 1,000 crores. Wherever I have had friends of CIOs and fund managers, they generally prefer for their own money relatively smaller schemes. And I also would generally think that's a good thing to do, but not for all your money, but at least in the small cap, mid cap category, going for smaller funds is more important than in the giant cap category.
All right, so now let's move on to our next question, which is from Rajneesh. And Rajneesh says that he's been investing 6,000 per month in equity mutual funds, and over the next 5 years, he wants to invest around 10 to 15,000 per month. Currently, he's investing in Nippon India Small Cap, HDFC Flexi Cap, SBI Flexi Cap, and he wants to understand if he should continue being in this fund.
Yes, Kavita, I think he can definitely exit an SBI Flexi Cap. A Nippon India Small Cap is a very good fund. HDFC Flexi Cap is a great fund too. SBI Flexi Cap definitely could have. Now, when you have another 10-15,000 to invest, Rajesh, to my mind, you can expand your portfolio with other categories too. A large cap fund, a Franklin India Blue Chip Fund, a DSP Equity Opportunities Fund, an SBI Contra, Kotak Emerging, and ICICI Focused Equity. It gives you exposures to 5 different categories other than the 2 you already have. So you'll have 7 schemes from 7 different categories. And that's going to be a reasonably well-diversified portfolio, not just from a stock perspective as an underlying, but category and also asset management companies being different gives you a diversification which is not just optical but delivered on the portfolio.
Do you think an active large cap fund is good to be recommended now in this current scenario?
Kavita, like you've asked the pointed right question, large cap as a category has found it the most difficult to generate alpha over the large cap benchmark, which is the top 100 schemes. but I think it's not impossible. So if we analyze from the time when SEBI categorized these schemes into different categories, it was in October 2018, if I remember the month right. After that, now we have come about 4 years into this whole categorization, which has brought in immense simplicity thanks to SEBI. If you look at large cap as a category, only 40% of the schemes in the large cap category have beaten the benchmark. 60% have not beaten the benchmark if you look at it year on year and average it out. The extent of alpha these 40% schemes have generated is only 2.8%. Now, to come back to your pointed question, in a large cap category, should we go for active? I think large cap is the most meritorious. If at all you want to consider passive, it's only in the large cap allocation can you consider passive. The alphas generated in other categories is stupendous for you to even imagine letting go of it in the pursuit of lower cost.
One more question. So now this contra category and focused category put together, there is no concentration risk involved, or there is, but it is also mitigated because there is further diversification done through other funds.
Yes, Kavita, you've answered your question beautifully yourself. So I would not want to, I would just echo what you said. It's concentrated, like focused means concentrated. Contra, not so much because it's saying contrarian bets, which itself might be diversified. Focus, surely, because they can't have by design more than 30 stocks. But an average mutual fund generally holds 50 to 60 stocks. Only 30 stocks, and most of them operate a 20 to 25 stock portfolio. So concentration is high. Since you're going to buy it as one of the 6-7 funds which you own, then you're not something to be worried about. If that's going to be your only scheme or one of the 3 schemes, then surely a focus category doesn't fit in.
All right, so that's the recommendation for Rajneesh. Now let's move on to Rahul, and a very interesting question, Feroze. He wants to invest in mutual funds to pay off his education loan of rupees 10 lakhs, and he says that he has to repay the amount in 5 years, for which he wants you to recommend some funds, and the maximum amount he can invest is 10 to 15,000 per month.
Yes, so Rahul, I think it's a sensible thing to do because education loans also give you some tax swaps and gives you tax breaks on your income. So I think it's always good to keep a education loan alive rather than paying it straight. So you're investing. So for you to invest, you will need 12,000 rupees a month, grown at 14% for 5 years to be able to pay your 10 lakh rupee debt on the education side. So that's point one. Now, the schemes remain identical. Of course, they're not on the basis of past performance. So some of them might not look rational at this point in time, especially Kotak Emerging, which is just given 9.5% last 1 year. Franklin India Blue Chip, which is the other scheme, which is just given 3% return over the last 1 year. But its future prospects seem very bright from here on. So DSP equity opportunities, HDFC FlexiCap, SBI Contra, and ICICI focused equity, like we recommended Ramya and Raj. In the same portfolio for you, Rahul, because your stature as a beginner remains identical to the other 2 callers as well.
Now, since we are talking about education loan, in fact, so let's talk about education for all those people who are about to achieve this goal for their kids, and the education now is just about to start somewhere abroad, and the currency situation has been too dramatic. What kind of recommendation you will give them?
See, when you're looking at education loan abroad, for those guys who have almost reached the stage where they need to spend that money to send their child, there's nothing much we can do. But definitely deriving from other people's mistakes or good doings, that's what finance is all about, and not making your own mistakes. I think anybody who has a child of 5, 10, 15, 12-year-old should start planning 10 years ahead, 8 years ahead, and start accumulating international funds or international ETFs for their global objectives. Because that gives you a hedge to the Indian currency depreciation. But fortunately, currency might have depreciated because most of us are not finance professionals. We don't see what kind of depreciation other currencies have had. India has stood very strong both on the economy side and also on the currency side. But when you look at a dollar at 81, 82, 83, it's very painful because you're not seeing it relatively. There are other currencies which have depreciated immensely. So to answer your pointed question, Kavita, anybody who has some time to start accumulating gold or foreign funds, which both have a hedge to the rupee depreciation, but the long-term depreciation of rupee over the last 15 years per annum is about 2.8%.
But then gold in this year has really not performed. I mean, it's obviously a hedge against inflation, but then there has been an underperformance. Do you think 2023 is going to be the year for gold, so one can really look at it?
Yes, Kavita, what happens is gold could sometimes, like these, when it doesn't look like an opportunity, is when most investments turn out to be opportunities. Gold has not rallied. So gold prices in rupee terms have not rallied. They've not rallied in dollar terms for sure for years, maybe a decade. Now comes because you get now, for example, 2023, the third tranche of the sovereign gold bond is just getting released. So there you're getting 2.5% extra. Gold has not shown performance so far, and you're getting the tax break. And then if gold performs, then you suddenly make a reasonable return. So I think this is the good time, especially to accumulate a dollar hedge or a rupee hedge. Sovereign gold bonds can do immense justice to one's wealth.
You mentioned international ETF. How can one go about this?
See, international ETFs, of course, a few months back, SEBI restricted the investments into international funds, but there are still 26 ETFs of the international category who are accepting funds. So you can buy, for example, a Motilal Oswal S&P 500 index fund, which invests in the top 500 companies as per market cap and free float of the US. So I think that's a very well diversified US index, which has industrial stocks, technology stocks, and what have you. But buying a NASDAQ fund globally may not be the right strategy because the risks are far too high because all of them are technology stocks.
All right, so that will be all today, Feroze. That's the amount of queries we have for you. Thank you so much for being on the show and helping our viewers plan their finances and their financial goals today. And with that,